Thank you for grabbing this week's edition of the Accunet Mortgage and Realty Show. I'm Brian Wickert, licensed real estate broker and also the majority owner of Accunet Mortgage, where my NMLS ID number is 259610. Here today again with my son, David, who's our president of Accunet Mortgage. David, what's your individual NMLS ID number?
328847. And our company NMLS ID is 255368, in case any regulator really wants us to just list all of the numbers.
All right. I think that's in our pre-recorded intro, but we got it in there twice. That's fine. So, boy, a plethora, David, of economic a bevy information this week. We had the Fed meeting, which was a big nothing burger, right? They came out and did nothing, which is exactly what everybody expected, except that two of the voting members dissented and said, they said, hey, we think we should have cut 0.25%, to get ahead of things.
Are both of those people trying to get the top job?
I believe they are.
Correlation?
I think that is exactly what's going on there. And so, the Fed came out and said, we're not doing anything now. And the odds, I think now as of Friday morning for a Fed rate cut in September are up to, is it 75%?
Yeah, it's approaching 80% now, as I just pulled it up.
And the other two things that we got this week were the inflation report that the Federal Reserve likes to look at, called the Personal Consumptions Expenditures Index, and that was a little hotter than was expected. I think, was it about 2.9% year over year, 2.8 or 2.9%, which is hotter than the 2% target the Fed's got in mind. But then the granddaddy, the big deal news of the week was, David, tell us.
The jobs report, Friday morning, 7:30 a.m., came in. We, America, in the month of July, created, allegedly, and I'm going to just bold highlight because I'm going to have a follow-up to this. We allegedly, in July, created 73,000 jobs, which, let's just put that in a jar. Hey, congratulations to all of us. We created 73,000 jobs. It's not amazing, but boy, there are years past where that would have been like, wow, good job by us. In comparison to recent reports, it's kind of like, fine.
Well,
hold on.
It was less than expected, right?
It was a little less than expected. But
not
the double whammy. Whammy.
Yeah, what's the double whammy?
The Bureau of Labor Statistics, wrote, it's pretty far. I'm on the website, and it is literally the last paragraph in the report. Revisions. Hey, revisions for May and June were larger than normal. The change, employment in May and June combined, is 258,000 jobs less.
That's the big news.
To which the entire bond market went, what? Wait, because, we all woke up on those mornings, those first Fridays, and heard, we created X jobs in May and X jobs in June. And then now the Bureau of Labor Statistics said, yeah, we kept staring at our spreadsheet, and we, America, made 250,000 less jobs. The bond market went, hallelujah.
Well, and that's because one of the things that's going to allow the Fed to cut the short-term interest rate, and also what is going to allow long-term rates like mortgage rates to come down, is a softer job market. And so that's what we're now seeing.
Tie it together. Jobs mean people have money, and when people have money, they spend it on stuff. If they spend it on stuff and there's not enough stuff, that's inflationary. So less jobs, and then you run it all the way down the line, might take the heat out of any inflation concerns.
Right. And I guess we should mention the other thing is there was the tariff announcement on Thursday night by the Trump administration talking about, we're going to slap on these heavy tariffs for certain countries that we haven't negotiated deals with so far.
I missed that.
Oh, yeah. Canada was one of them. I think we're going to a 35% tariff.
On maple syrup or other?
Yeah, other stuff too. But anyway, so that could have made mortgage rates worse. But the bottom line is because of the weaker than expected and mainly perhaps the revisions to the previous 2 months, mortgage rates got better on Friday. David, where did we end up? Where are we at the time we're putting this into electrons?
Into electrons on a 30-year fixed with all the right stuff, including 780 credit, 25% down, and I used a $400,000 purchase, which is a $300,000 loan. any Accunet client could fetch 6.625% with no points. APR is about 6.71, and but Dad, you know, it's all a matter of perspective. It always feels, it's like stepping on the scale. It's like, hooray, I weigh 5 pounds less. It doesn't mean that suddenly now I'm ready, I'm TV ready. It just means, you know, I'm 5 pounds less. Because Dad, what do you think the payment difference is?
I was just calculating that.
Okay, what do you think the payment difference is between 6.875 and 6.625 on a $300,000 loan? I have it.
Okay, what is it for that?
The answer is a whopping $53 a month.
Okay, and the one I did was...
Honey, grab the car keys. We're going out and we're going to go look at a house because Brian and David can help us save $53 a month.
It's better than going the other way. I did the payment difference at $699 versus $6,625, and that comes out to $73 a month. So, you know,
that's that's the cost of one DoorDash.
Okay, well, it's better than going the other way.
Well, I know. Well, but here's the, especially in our own backyard. Hey, congratulations, you have a quarter relief relatively, right, compared to maybe the last time we spoke into microphones. The way that home buyers, precious few home buyers are going to pocket that savings, Dad. Instead, what they're going to do is they're going to, right, hey, I want a monthly payment of X. They're going to keep the monthly payment of X and broaden perhaps the amount of home that they're looking at. Because now you can borrow $8,000 more.
Oh, and get the same payment.
With your quarter savings in my example.
Okay.
Which is what most home buyers are going to go do. So there's not really relief, there's just stretchier.
Okay, little uptick in the home purchase price. Well, that's all again relatively good news. We'll take it, put that in the bank, and give our home shoppers and refinancers, we're doing some refinancing, a little better deal. All right, let's take a quick break, David, and then when we come back, let's take a look at, I've got a first-time home buyer story, a happy story of a couple that closed this past week, Monday. We'll be right back. Welcome back, and thanks again for grabbing a copy of today's podcast, and or if you're doing the video, the video, what do you call it?
Just video podcast? Come on.
All right,
show. We can make a show.
So, David, this last week, we had a first-time homebuyer couple succeed after, I think, 2 previous unsuccessful tries. I think they wrote their first offer in late 2024, and then they wrote another offer in early 2025. Both of them kind of died on the inspection.
Oh, they had 2 houses under contract, and each time they said,
Yeah, there was enough wrong with it that they didn't want to proceed. And then they wrote some other offers in the meantime that they did not win on. And they were shopping in the hot Wauwatosa single family market in about, let me just check and see what the price range was. Yeah, they were in the mid 300s, so a lot of competition. And much to my delight and surprise, they were able to get a house under contract ready underneath the asking price. What? Okay. When does that happen? Which probably maybe only means that the sellers were asking more than they should have been. But
yes.
And so this is a case like you were talking about, where they had in their particular case, David, a particular amount of money that they wanted to bring to closing. So they weren't as monthly payment sensitive as, hey, here's the dollar amount that we want to bring to closing.
Was it a gift? Is that why?
No, they just wanted to have enough savings left over to, do things to remodel the house, or just to have as a cushion.
How do you want your steak? Fine.
No, I thought that was smart. Although I'll tell you, one of the things in the check down to closing that we are conscious of and help people think through, the money was in a joint account with one of the buyers' parents. They still had an account. These people are in their 20s, so they still had a joint account, and it was in a bank in Iowa. And so I said, you got to make sure, this was like 10 days before closing, you got to call that bank and make sure what the procedure is, because here they are in Milwaukee, the bank account is in Iowa, and her parents are on it, because sometimes banks make people show up in person.
To your point, like let's PSA side story, because every financial institution is different. The artistry of being a good mortgage advisor is talking about, right? It's not just, see you at the closing table.
Yeah.
Which is the bank skyscraper way in which someone would get help or not help. But to your point, Accunet loan consultants, it's like, let's talk about real life. So, right, because, that Iowa bank, if you want to send more than $1,000, you need to walk in and shake the hand of the branch manager and give a blood sample if you want to do that. You don't want to find that out the Thursday night before your Friday 10 a.m. closing.
Righto. So I actually called the bank myself about 10 or 14 days to kind of check that out. And they told me, no, you don't have to come in. But I asked our buyer, hey, you call and make sure exactly what the procedure is. And they did not have to show up in person, which was awesome. And so that all went smoothly and swimmingly. And so after 2 unsuccessful tries, and actually more than that, because they had the offers where they came in second or worse, they are now homeowners. Yay!
Hey-o.
Yep.
Good.
And probably getting ready to move.
Can I just on that just more on the real life? I have a client buying a home on Friday here, and because you were helping your client make sure that they could remit the money. I had a client, it's almost like he read my mind. He did a practice wire.
Oh, wow.
He sent, 100, maybe 500, $1,000 to the title company to make sure, a dry run that which is exactly what David would do buying a house. It's like, before I send you all the money, let me send you a schnibble. And then you tell me that it was okay, you got it. Of course, then all that means is he doesn't, the second amount of money he wires or the biggest chunk, he doesn't have to send all that he needs for closing because he already sent some. But talk about a savvy move, with your Iowa bank or online banks are another,
category
of like, hey, what are your rules? And doing that practice, because not to pick on, the non-metropolitan financial institutions, but if that small town bank only does, their wire remittances once a day on, at 3 p.m., you want to know that ahead of time because it's not a large financial institution maybe doing wires every hour on the hour, for example. You don't want to be late on that part either.
One other public service announcement on getting the money to closing. Sometimes people have money in different accounts and then they move it around. Well, you don't want to move a large chunk the day before you wire it out because banks have this thing called holding periods. So if you're, moving money in, they might say, well, you can't move that $25,000 out now for 3 days.
Yes.
So that's another thing in our talk track as we're getting people ready, but just in general to know, it's not instantly available in many or most cases. So planning on how to get that money to the closing table is an important step in the process. Most of the time it has to be wired. I think if it's under, $25,000 now, a cashier's check, and it depends on the title company involved, can be used instead of a wire, but wiring is most common. That's not something people do every day. All right, let's take another quick break, David, and then when we come back, I think you've got a story to share.
I do.
We'll be right back.
Welcome back to the Accunet Mortgage and Realty Show. I'm David. That's Brian over there. Dad, we've enjoyed helping a couple of our past clients refinance here summer of 2025, which is always fun because it's those clients who probably, if they had moved in last year, and the conversation that I have with clients, as they get ready for the purchase, and we're consulting on closing costs and rate and that balance. A lot of these clients who are enjoying the opportunity to refinance were the ones who said, David, I think rates are going to come down sometime in the near term. And in fact, those clients were right, and they had no sunk cost on their purchase mortgage game plan. So when I call them to be like, hey, can I save you $4,000 in the next year? They're ready to say yes. Well, which is a separate time. I need to try to explain the temporary buy down refinance, the accelerated savings refinance, if we were to brand it. But they're ready to say yes because they have no, right? They're not thinking of themselves, hey, David, well, but I paid points when I purchased my home. You know, why did I spend that money if I'm just trading it in? And that's when I say, well, turns out rates came down faster than the value of you paying up to get into the home. But on refinancing, you know, purchasing and getting ready is kind of again, it's like having a baby. It's like,
it's coming.
The baby is coming. It's happening.
And the numbers are the numbers.
The numbers are the numbers. But a refinance is like a wardrobe change. You're like, well, I don't have to do this. Like, would it be nice? Yes. Will my life keep going if I don't get a new wardrobe? Yeah. And so understanding, I like to call them maybe about like the 2.5 rules of refinancing, which first is be mindful of closing costs, right? Because if Chase Bank says, yeah, we can save you $1,000 a year, you just look over here at the,
and it won't cost you. And it won't cost you anything. Yeah.
$3,000. It's like, well, no, you're not. That break even isn't either as fast or as real as you've been led to believe if you're only focusing on the rate.
Yep, the rate and the payment, because you want to be looking at what the loan estimate has as total loan cost. And then even that's not the end of the story.
No.
Because in a lot of cases on these refinances, we're paying for some or all of those loan costs. And that shows up in a different part of the loan estimate called the lender credit.
Yeah.
So you really got to look at those two items together. You know, ideally, you know, you're seeing $1,400 for loan costs, and then you're seeing a $1,400 lender credit. That's the best, or in many cases, the best, because you didn't spend anything.
Clients are savvy to be like, well, what's my what's my balance on my old loan, and what will my balance be on the new loan? And that needs to be as near the same if you are going to legitimately declare, you know, this is either a no cost or, you know, no excess cost refinance.
Well, but there's another angle on that, you know, for the person, let's say, who is escrowing for taxes on their old loan.
So because I have a client who's doing this exact thing. They have they currently have 10% equity. And so they are required on a conventional loan to escrow for their property taxes and homeowners insurance. Some mortgage servicers who take in the monthly payment aren't smart enough to know how to slide the old escrow account over to the new escrow account.
Right.
And so you're kind of my 2.5 rule. It's the artistry of refinancing. It's like, okay, client, you know, there is a benefit for you to refinance. Pay less for the same home. Let's be mindful. Do you want to roll in the cost of funding your new escrow account? Then you get a check back from the old one. And then, well, do you want to pocket that? Do you want to make a principal reduction on the new loan so that your true net effect is closer to neutral on the loan amount? That's of the many things I enjoy about mortgage lending, that puzzle piece and being able to say those words like a regular human. I also have had clients who are like, no, I'll just bring the money to closing to fund the escrow account, and then they're just going to basically reimburse themselves when they get the old escrow account.
The other thing that people sometimes don't realize is that there's always at least 1 month of interest due at a refinance closing in lieu of your next monthly payment. Sometimes, depending on when you close, if you close like the first week of the month, there can be 2 months of interest that are paid at closing instead of just the 1 month. And again, that's a discussion of, do you want to bring that money to closing? And I would never characterize that as a cost, because you're going to pay interest every day you have the loan, regardless of whether you refinance or not. So we're just changing the timing and method of how you're going to pay for that month of interest. Instead of paying it with your normal monthly payment, you're going to pay it at the closing table. Somebody closing here in early August isn't going to have a first monthly payment until October 1.
Yes.
Because we're going to collect interest for the rest of the month of August at the closing table.
Time out.
Yeah,
I learned something new this week in mortgage lending.
What?
I've been doing this a long time. As our old friend John Vels would like to say, you learn something new every day in this mortgage thing. Dad, you could do a reverse interest credit if you wanted to avoid that extra month of interest. Again, this is like being one of those really good suit tailors. Like your refinance, because I have some clients, let's do a 29-year.
Oh yeah, I've seen that's being very commonly done by the Accunet team. Is, hey, you got your loan 9 months ago. Do you want to do another 30-year loan, or would you like a 29-year loan? So we can customize that loan term to any number of years between 21 and 30.
My other note, just on the rules of refinancing: don't be a gambler. Don't play blackjack with your refinance. Like, yeah, but David, I think rates are going to go lower. It's like, how's about we take the savings now, enjoy that, and then you know what? God willing, I'm going to call you again come Valentine's Day, and I'll say, good thing we didn't spend any money on that refinance either, and let's make this mortgage money better, faster, cheaper, stronger. Again.
Well, in terms of that forecast, I did see Fannie Mae updated their interest rate forecast, and instead of getting down to 6.5 by the end of 2025, they're now predicting 6.4. So a schnibble less of interest. And I think they went from, is it 6.1 at the end of 2026 down to 6.0. So we hope they're right. They haven't been right very much lately. People have been forecasting lower rates for a couple of years now, and well, hey, they're better today than they were 2 weeks ago. Yeah, Thursdays. Yeah. So we'll take it. All right. Do we have anything else to talk about?
I have a home buyer story that I just want to crack open a little bit. So let's cover that after we take this quick break. Thanks again for hanging out with us. I'm David, the younger, taller, more handsome of the Wickard men. That's Brian, the wiser, over there. Dad, I had a client get an accepted offer on a duplex this last week.
A duplex, yes.
And one development in the last couple years is that Fannie Mae and Freddie Mac have made the down payment requirement on a duplex a little more manageable. In the past, you could be required to make as much as a 15% down payment on a duplex. When you run that through the mortgage underwriting software, because that was just the rule of the road. We could get into what are the policy reasons that used to be the case, but that was the lay of the land. There were some exceptions. If you fit in the box for some first-time homebuyer programs. By the way, for these duplex 2-unit homes, this is assuming and certifying that you are going to move in, that you will occupy as your primary residence.
Yep, you're going to occupy one of the units and then rent out the other one.
Because off the top of my head, it's an investment property and you're not going to move in, and it's a multi-unit, 25% down, please, and reserves, which is money in addition to down payment as buffer. So the development the last couple of years has been Fannie Mae and Freddie Mac have gotten a little easier, that you could, if you get approval through the underwriting software, put as little as 5% down on a duplex if it is your primary residence, which is nice. That makes it a little easier to get into as a home buyer. I mean, right? 5 versus 15 on a $400,000 house. That's $40,000. It's like, honey, we can get into that house and we don't have to save up this ginormous extra chunk of change.
Right.
By comparison, just by the way, FHA, whether it is a 1 family up to a 4 family, will allow as little as 3.5% down. Of course, FHA comes with its own perspective about the health and condition of the home, as well as can I get a seller to say yes to me to an FHA loan, but let's set that to the side. Dad, the other element, or what I want to take your temperature on, my client, they are buying a $400,000 plus duplex, to which I'm like, is this the biggest duplex in all of southeastern Wisconsin?
Oh, no. There are other bigger ones, but go on. What's your question or what's your comment?
Underwriting allows that we can use the rental income that you will receive from the other unit that you're not living in. You can use that to qualify. The dad part of my brain, though, is always thinking like, you probably would benefit from having, not because mortgage underwriting is going to require it, but in real life, having my tenant lost his job and couldn't send me his rent check, because the mortgage payment is what it is. The mortgage payment doesn't care if your tenant is on time or not, has a job, is in the unit. And so that's why there's a reserve requirement from underwriting.
Yep.
But after you close, there's no like continued reserve requirement to own the home. But when you get into that higher monthly payment for a larger duplex, having that buffer, because you're not as I make the joke, if you have rental units, you're not a landlord, you're a superintendent up until you get to a certain level of scale.
Right, because you're fixing the toilet or whatever is going wrong.
I guess, so what are you, because buying a duplex, and this is a young couple, right? They're in their late 20s, buying a duplex. Yeah, hey, the people across the way, they're going to help us, have an effective monthly payment of a lot less. But it's like, it's the same caution about owning a condo. It's like, be ready for unexpected things.
Expenditures. A question though, in this particular case where they're able to put 5% down, did the underwriting software require reserves or not?
Yes, it did.
How many?
Months.
Oh, 6 months reserved. That sounds like a Fannie Mae underwriting.
It is.
Okay, but doesn't Freddie Mac allow for less reserves sometimes?
Sometimes.
Okay.
Again, it's the underwriting software being a black
box a little bit, yeah.
Sometimes. But again, and they have the means, but it's the real life element that I think is worth talking about with a client. And like, you know what, God bless, like they're going to go do it. But presuming that I'm going to have a tenant in the other unit 365 days a year.
Yeah, it's nice to have a little fallback.
Yes. But that's available, for anyone out there looking at duplex financing. The lift doesn't need to be, there's a lot of variables, but the lift is less here in 2025 than it used to be.
Yeah, buying a duplex is a special thing. Did the program that you're using here require landlord training, or is that only if they go? Okay, so they had to take it, not only a first-time homebuyer class, but also a little online landlord.
Which you can do at 9 o'clock at night sipping on a beer. It's not like you're like getting ready for the LSAT or anything.
Yeah. All right. Well, congratulations to them. Oh, I was going to say one other thing. They have to occupy within 60 days. That's a rule for any primary residence. You have to move in within 60 days of closing. And then they're also promising to occupy the property for at least a year afterwards to not have, they don't want you moving in and then, just kidding, we're going to turn it into a rental property. All right. Are we ready to wrap it up, David?
Yeah, that's all. But I'm glad we were able to connect. I'll be interested to see if the bond market and mortgage rates hold on to its rally from the jobs report here on Friday, or if we give it away. It couldn't possibly just stay flat, Dad. It has to do, up, down, sideways is boring. So we'll see.
All right. Thanks for grabbing this week's edition of the Accunet Mortgage and Realty Show. We'll see you again next week.